However, in recent years, the bank's fortunes have taken a dramatic turn for the worse, leading to a stunning downfall that has shaken the tech industry. Imagine a once thriving bank serving as the lifeline for tech startups across the United States, with a unique approach to assisting clients. Now, picture this bank collapsing in a shocking downfall, leading to a bank run and billions of losses. What caused this catastrophic event to occur? Brace yourself for a tale of greed, mismanagement, and betrayal as we uncover the jaw-dropping story of the stunning downfall of Silicon Valley Bank. Silicon Valley Bank was once considered a leading financial institution, providing banking services to tech startups and venture capitalists in the heart of Silicon Valley. With a reputation of innovation and risk-taking, SVB was at the forefront of the tech boom in the late 1990s and early 2000s. However, in recent years, the bank's fortunes have taken a dramatic turn for the worse, leading to a stunning downfall that has shaken the tech industry. In this video, we will explore the rise of SVB, the reasons behind its decline, the consequences of its failure, and what this means for the future of the tech industry. Silicon Valley Bank originated on October 17, 1983, as a wholly owned subsidiary of Silicon Valley Bank shares, now SVB Financial Group, co-founded by Bill Biggerstaff and Robert Medeiros, who conceived the idea during a game of poker. The bank's initial location opened in 1983 on North 1st Street in San Jose. Primarily, the bank's approach was to gather deposits for companies funded through venture capital. It then broadened its operations to include banking, financial venture capitalists, and introduced services to help retain clients as they transitioned beyond their startup phase. Following a merger with National Intercity Bancorp in 1986, SVB opened an office in Santa Carla. Then, in 1990, the bank established its first office on the East Coast, near Boston, catering to the Massachusetts Route 128 Tech Corridor. During its formative years, the bank had a substantial real estate loan business, which made up 50% of its portfolio in the early 1990s. However, a downturn in the California real estate market led to a $2.2 million loss for the bank in 1992, and by 1995, the portfolio percentage had declined to 10%. Silicon Valley Bank enjoyed a surge of business during the dot-com bubble. Due to the wave of computer technology startups, the bank's willingness to lend to venture-stage companies that could have been more profitable made it popular among clients such as Cisco Systems and Bay Networks. In 1995, SVB moved its headquarters from San Jose to Santa Carla and continued to add branches and technology hubs across the country. Although the holding company's stock price soared during the bubble, it fell 50% when the bubble burst. Ken Wilcox became CEO in 2000 and maintained the company's niche focus on technology companies instead of diversifying into a broader commercial bank. In 2002, SVB expanded into the private banking business, leveraging its prior experience and relationships with wealthy venture capitalists and entrepreneurs. 2 years later, it announced an international expansion drive that included new operations in Bangalore, London, Beijing, and Israel. Following the financial crisis of 2007-2008, SVB Financial Group was granted a $235 million investment from the federal government under the Troubled Asset Relief Program. In exchange, it issued preferred stock and warrants. It went on to pay $10 million in dividends to the U.S. Treasury over 2 years before later purchasing back the government's interest with the proceeds of a $300 million stock sale. In 2012, SVB partnered with Shanghai Pudong Development Bank to create a separate bank in Shanghai that would lend to local technology startups. The new bank, co-owned by the two companies, was granted permission by Chinese bank regulators to operate in renminbi, making it one of the few American-owned banks allowed to do so. SVB also managed 2 local yuan-denominated funds for Shanghai's Yangpu district government and invested in a Hangzhou-based loan guarantee company. SVB was hit hard by rising interest rates and the tech industry downturn starting in 2022, which accounted for most of its liabilities. By the end of December 2022, it had recorded unrealized losses of over $15 billion for securities held to maturity. Then, in March 2023, the bank faced a series of issues, such as poor risk management and a bank run by tech industry investors, eventually resulting in its collapse. As a result, many of its customers, including Silicon Valley startups, withdrew their funds and deposited them in other banks like Brex, JP Morgan Chase, Morgan Stanley, and First Republic. To prevent their portfolio companies from facing risk, venture capital firms advised them to move their funds out of SVB. Founders Fund, for instance, withdrew its funds from Silicon Valley Bank on March 9th, which helped to support several startups that were banking with SVB. On March 10th, Federal Reserve and FDIC regulators arrived at SVB's headquarters to assess the bank's financial condition. Subsequently, the California Department of Financial Protection and Innovation issued an order to take possession of SVB due to insufficient liquidity and insolvency. The FDIC was appointed as the receiver and established the Deposit Insurance National Bank of Santa Carla to reopen SVB's branches the following week and enable access to insured deposits. After its closure, SVB's CEO Greg Becker resigned from his position on the Federal Reserve Bank of San Francisco Board of Directors. Although SVB's failure was the largest by assets since the 2007-2008 financial crisis and the second largest in U.S. history after Washington Mutual, its Chinese joint venture maintained that its operations were sound as of March 11, 2023. Silicon Valley Bank was renowned for serving primarily businesses and affluent individuals in various industries, including technology, life science healthcare, private equity venture capital, and premium wine. Its unwavering commitment to its clients led it to announce in 2015 that it served 65% of all U.S. startups, a staggering achievement that solidified its position as a leading player in the financial services industry. As part of its innovative approach, Silicon Valley Bank offered various new services, including syndicated loans and foreign currency management. Additionally, it was the only financial institution in the United States working with virtual currency startups at the time, showcasing its forward-thinking mindset. The bank also gained a reputation for its unusual accommodating approach to serving startups in India. In particular, it was willing to work with C corporations whose founders lacked social security numbers, a significant obstacle for many other financial institutions. This further cemented Silicon Valley Bank's position as a go-to financial partner for startups, both domestically and internationally. As of December 31, 2022, Silicon Valley Bank's loan portfolio was heavily weighed towards venture capital and private equity firms, accounting for 56% of all loans. These loans were secured by limited partner commitments and used to invest in private companies. Additionally, 14% of the bank's loans were mortgaged for high net worth individuals, while 24% were extended to technology and healthcare companies. Notably, 9% of all loans were to early and growth stage startup companies, reflecting the bank's ongoing commitment to supporting the next generation of businesses. Once a lending player in the technology startup arena, Silicon Valley Bank met its demise due to various factors, including poor risk management and a bank run caused by tech industry investors. The bank's collapse had a ripple effect throughout the industry, prompting venture capital funds to advise their portfolio companies to transfer their funds out of the bank to prevent being caught up in its potential failure. In the end, regulators took over SVB due to insufficient liquidity and insolvency. The FDIC created the Deposit Insurance National Bank of Santa Carla to reopen the bank's branches and provide access to insured deposits. SVB's failure was the most significant in terms of assets of any bank since the 2007-2008 financial crisis. It is a cautionary tale about the hazards of depending too heavily on a single industry and the significance of sound risk management practices.